Okay, ladies and gents, welcome to MACROACE with your host, Tony. Let's get into the data. We've got about 30 minutes until we get to inflation. So first of all, let's kick off with what it is. It represents how much consumers pay for retail goods and services. And the way that it's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas where prices are collected on 80,000 different goods and services. So the key measurements then, the breakdown of it is you have the housing, which represents about 42%, food and beverages represents about 14%, transportation about 18%, and medical care about 8.5%. Then you have the core retail, the core CPI data, which excludes food and energy. Usually the seasonally adjusted data is more preferred. So of course you have the CPI month to month and core CPI month to month. CPI, so the essay is usually preferred to strip out the effects of the economic cycle, weather, production, and anything else that's affecting the economy at that time. If there is a big amount of spending that usually happens at a certain period of the year. So that's the key thing to understand about what the release is. And let's get into what the difference is between PCE. Is this live recorded, pre-recorded? No, you're watching it live, buddy. You're watching it live. I'm here. Wundgesockt. So hopefully that should tell you that it is live at the moment. Okay, so the difference between PCE and CPI is that PCE places a lower weighting on prices of gasoline and residential rents and focuses on the nation as a whole rather than focusing on urban areas. Then how does it affect the markets? With the dollar tends to see strengthening when the economy is growing, particularly with inflation if it's much stronger than expected. With the stock market, it would take a hit, or you see a bearish market reaction. You would see a bearish market reaction because, of course, inflation. If inflation is much stronger than expected, then that will have an impact on the Federal Reserve, who are also expected to deliver their rate decision and the summary of economic projections, which will include the dot plot and where they see the federal funds rate. Do we get no rates at all, no rate cuts at all this year, or do we get one, or does the Fed go, kind of stick to their guns and say, okay, we'll probably we'll go with one or two rate cuts this year. Now, for the bond market, if you have data that is stronger than expected, actually, let's go with weaker than expected. If the data is weaker than expected, bond yields will usually see a decline because that means that the central bank is more likely going to cut rates sooner rather than later. So the yields then start to go down for those bonds as the value of the currency also starts to go down as well. For bond prices or the bond futures that you look at, those prices, the bond futures prices will then start to rise due to bond yields going lower. Okay, now in the previous report, then for the core CPI month to month at the May reports in the May report, looking at the April report, the April data. Increases were seen in shelter, motor vehicles, insurance, medical care, apparel, and personal care. Decreases were seen in used cars, trucks, household furnishings and operations, and new vehicles. Then, where is the economy at the moment? So we had non-farm payrolls, which was much stronger than expected, and they had about a 90k deviation. It was at 272k compared to the prior of 165k. Unemployment rate ticked up 4% from 3.9. Average earnings also ticked up as well to 4.1% compared to 4%. Employment costs ticking up to 1.2. PC price index and core remaining unchanged at 2.7 and 2.8. Prices paid for manufacturing at 57, so decline from 60.9. Services declined to 58.1 compared to 59.2. Productivity declined to 0.2% compared to the prior 3.5. Import prices rising to 0.9% and export prices declining to 0.5%. PPI data, which of course is going to happen tomorrow as well, but PPI rose to 2.2% and core PPI also rose to 2.4%. All right. So the picture that's being painted here is that the labor market is still relatively strong. And then the potential for the pressure then in the future to add to inflation starts to increase as that jobs market continues to remain solid and strong. No impact in the immediate term, but the expectation in the future is that will then have some. The earnings year on year starting to rise again and going to 4.1%. That's also another concern then for the central bank. If earnings start to rise, if people are getting paid more for their earnings. But the PC data, their preferred measure of inflation, remaining unchanged, but not moving, not seeing any move towards the downside. So a bit of stickiness there at that point. And the PC data, when that does come out, could then provide the impetus or not, or no impetus to cut rates this year at all. Or, of course, it depends on what the dot plot says. Or maybe decide to cut rates by one time rather than the expected 2 rate cuts that we have so far for this year. All right, here are the triggers then for the economic release, with the CPI year-on-year forecast at 3.4%, with a high estimate of 3.5 and a low estimate of 3.2, with a deviation of 0.1% and 0.2% on the high and lows. Core CPI, high estimate of 3.6% and a low estimate of 3.4, with a deviation of about 0.1 on either end. Month on month, with a high and low estimate of 0.2% and 0.1%, and a deviation of 0.1%, and remaining sticky on the low end. Core CPI, and then the core CPI also with a 0.1% deviation on either end. Now, to be honest, if we're looking at the data and we're looking for a really good market reaction, whether it be up or down for the, let's say for the stocks, stock indexes, or for the dollar, or for ZT or the two-year bonds, then you'd want data going all in one direction rather than being chopped up and mixed. If the data is chopped up and mixed, then it's harder to kind of gauge which way the market's going to go, and then you're reliant on the direction of the move that takes place, and then that makes it even riskier. So ideally, we'd want big enough deviations to see the markets then have a bigger reaction that is clear in one direction, rather than seeing a mix in data and then you get a more choppy market reaction that could then occur. So that's what you don't want to happen, is mixed data. If data is higher than expected, as said, then we'd probably, if we're looking at the highs here, the deviations probably want at least a 0.1 deviation for maybe even at least a 0.2% deviation for the CPI year-on-year data. Now that would really throw the market's expectations out for a rate cut to possibly just December. Of course, bear in mind that you had Nick Timiraos that said that the central bank is also going to be focused on this print as well. Now, does it mean that the dot plot is going to change? If they've seen the data already, or if they're going to see it at this for this data here when it comes out, either way, it will have an impact if it is much higher than expected, and then that means the idea of a 2024 rate cut goes out the window, and you can say sayonara, baby, and you can wait till next year. But if the data is much lower than expected, then the expectation is maybe a third rate cut could come back into play, and maybe July could even come back into play. So you could have, maybe not July, you could have September, October, and maybe December, where the so the central bank could decide to skip one of the meetings. But a third rate cut could come into play if the data is much weaker than expected, and if it is much weaker than the prior figures too, for the core and the headline year-on-year data. So that's what we also need to be aware of, is that we're not just looking for the data to be weaker for the weaker or stronger than the forecast, but we also are looking for the data to be weaker compared to the priors as well by a good margin, enough for the markets to more than enough experience a lot of volatility within the markets. So if the data does come in, let's say if the previous was 3.6 for the core and then we got 3.7, of course is much stronger than the forecast and stronger than the prior figure too. So that will then provide a even bigger market reaction to the data that we've seen in the past, or potentially that we've seen in the past, and would then provide a good opportunity for them to be able to clearly understand which way the market's going, and you know why the market's going in that direction, rather than it being mixed and you're kind of putting your thumb in your mouth and going, worrying about what to do. Okay, let's carry on then. So with the expectations and sentiment and views, we've had JP Morgan on 7th of June that said the two main tail risks highlighted by panelists were persistently strong core inflation, causing the Fed to remain on hold until after the November elections, and a US election outcome that impairs US engagement with the rest of the world. So there's the fear if you do have core inflation that is much stronger than expected, but you start might have to raise rates as a very extreme scenario, but it's not, it can't be off the books altogether. Then that could then provide a little bit of havoc to the markets with the US elections and where the rates are in the US. So ideally, you'd want stability where you don't really take any decisions before or just before the US election occurs. So ideally, they wouldn't want to do that. So they'd rather have stability, so everything's all fine. JP Morgan. So from JP Morgan, MUFG, they said on the 10th that another upside inflation surprise could prompt the Fed to scale back plans for rate cuts this year from 3 projected back in March to just 1. Whereas a second consecutive softer print in May could provide more reassurance that the pickup in the first quarter was just temporary and favor the Fed scaling back rate cuts plans to 2 rather than 1. So that's something to be aware of the expectations then, how the markets will then price in what the central bank could do in the future. Morgan Stanley went on to say that they forecast core inflation at 0.28% for the month-on-month and 3.5% for the year-on-year on lower services inflation. And Goldman Sachs, they expect 0.25% increase in the May core CPI versus 0.3% again for the month-on-month, and corresponding to a year-over-year rate of 3.5%. So as same as the consensus of the expectation for the CPI year-on-year print. They expect a slower pace of inflation in consumer electronics, personal care, and other consumer products. Okay, then if we look to the Fed comments then of what's been said in the past, Fed's Bostic said it would not surprise me if it took longer to get to 2% inflation in the US than elsewhere. Gorsby, also just another comment from Fed's Bostic, on May 3rd, he said, I don't think a rate hike will be required to reach the 2% goal. I expect to reach the inflation goal without any unemployment jump. Gorsby said that housing inflation is still well elevated compared to pre-COVID levels, and that'll be hard to get to 2% unless that changes. So the housing data part of the report is also going to be quite important for the Federal Reserve to take in, or unless they have taken in already, if they've been given the data. Fed's Williams says that we don't need to be exactly 2% cut rates, and Fed policy is well positioned to get inflation back to the 2% target. Kashkari on the 28th of May said that I certainly won't pencil in more than 2 cuts for 2024, and I don't think anyone has taken rate increases off the table. So that's the fear then for the markets. If data is much stronger than expected for the equities, if you do get data that is much stronger than expected, that a chance of a rate hike coming back onto the table would one, lead to the central bank throwing out 2024 rate cuts altogether, and two, the potential for a rate hike to be seen next year, potentially, in the dot plots. So that's the fear then, that then leads into the FOMC could then provide a really bad day for the equities and the stock indexes overall, and a wonderful day for the dollar. Okay, let's carry on then. So with market pricing, got quite a bit of that actually. So we had post CPI data on May 15th. Fed swaps priced in faster pace of 2024 rate cuts. Traders firm up bets on Fed rate cuts in September and December. Then May 22nd, post the FOMC minutes. Short-term interest rates in the US futures were down after the FOMC minutes, and traders still betting on September start to Fed rate cuts. May 31st, the US short-term interest rate futures rise after PC data as traders add to bets on Fed rate cuts, and traders firm up bets on Fed rate cuts in September and December. Fed swaps on June 4th from the JOLTS data post the weaker than expected. JOLTS data, you had the pricing in faster pace of 2024 rate cuts. Excuse me, ignore that bit. If we look to June 5th, so with June 5th, you had the Fed cut rates by 50 basis points this year, according to 68 of 116 economists in the May poll. 28 said 25 basis points and 5 said no cuts. And then for non-farm payrolls that we had last week, Fed swaps no longer fully price in a rate cut before December. So one rate cut is priced in. Interest rate futures traders slash bets on September Fed rate cut, now giving it a 55% chance compared to 70 before the jobs data. And then just to add finally, JP Morgan off the back of their non-farm payrolls data, they changed their first Fed rate cut view to November from July. So that's a pretty big old jump that has been taken there. So going into November, all the way past the other meetings that we have. So then the risk then becomes for this meeting, if data is stronger than expected, if we've already had a pricing out of 2 rate cuts going now to 1, that we get no rate cuts at all. But then the FOMC could surprise if they still feel that it could still okay to cut rates once this year. Then that may lead to a bullish reaction to the equity indexes when the statement comes out with the rate. But of course, let's wait for what the data comes out as, and then we'll start to either panic or go yay if you're an equities trader. But to be honest, if you're day trading, the key thing is you're looking for the opportunity, whether it goes up or down. So whether the data is stronger than expected or weaker than expected, that's not going to matter. You just want a clear, clean direction in one way, with the data either being much stronger than expected or weaker than expected. Any confusion in the data, like I said earlier on, then you're kind of wobbling a little bit within the market, or potentially, and then you're not going to have a great day. Okay, so let's carry on then. So this is the last CPI data that we had. This is about 10 seconds before that. So you see the data was in line with expectation for the core and the year-on-year CPI, but you had don't know where that came up from. But you had the other areas for the CPI month-to-month, and you had core CPI month-to-month that had also remained flat. CPI month-to-month was the only bit of data that had seen a decline there to that figure. It's kind of a bit hard to see. But from the deviations then, which I'll quickly go through, we had that jump that had declined to 0.3% for the month to month. So data was weaker than expected, and while data was more or less in line with expectation, with the outlier being the month to month, the markets had seen a positive reaction. So the scenario then, if I just kind of skip ahead, and you can see how the market reaction kind of held up for quite a while, for quite a bit, for over 20 minutes or so. Let's skip ahead a bit more. Okay, I wonder if I should be able to go. Okay. Yeah, so it had a decent market reaction from the data that was in line with expectation, and then a decline from the month on month, which then provided the impetus to go long on the S&P. Okay, let's get out of that here. We've got about 8 minutes left. Let's go through the ranges and deviations. So with the deviations sheet, we'll see what had the biggest market reaction here. So if we have a look, so I said data you had seen. Now that's also another scenario. So if the data comes in as expected, then one way the market take it is that the disinflation process is stalling, and we're not moving down fast enough, and then that could lead to a decline for the market, a decline in the equities, and a rise in the dollar, or the decline in the stock indexes and a rise in the dollar. Or another way the market could take it is that disinflation is taking a bit longer to do its job, but it's not rising, and we're not seeing a rise in that data. So that means that could then provide a move towards the upside for the equity indexes, if they feel that the inflation isn't going to go up, or is just stuck at 3.4%. For the core data though, if that does go down 3.5% and comes in as expected, again that could help the bulls in the equity indexes to say, okay, yeah, data is in line with expectation, but we are going down slightly for the core data, and that might be enough to provide a move towards the upside. However, if you do so, again, but this is what the market reaction was last time around. We had 1 point of data that was weaker than expected, that then helped to provide this movement towards the upside on the Nasdaq by 571 ticks on the initial market reaction, going to the wick of the candle. This is all on the 1 minute chart. Then here in the black brackets, we have the movement 10 minutes after the economic release has occurred, and then after about 30 minutes in the blue brackets, the market reaction, the movement of the NQ here. So we were still up by 374 ticks, but we had made our way back down from about 571 ticks from the initial market reaction. Okay, so you can see here with the print before that in April that we had a really decent market reaction that continued to rise after about after the initial market reaction, and then kind of hovered back a little bit after about 30 minutes. So see here, when you do get deviations that are stronger than or all in one direction, then you get a more decent market reaction. With the outlier here being where you might have seen all the other bits of data here seeing a move towards the upside, and then 1 point of data seeing a bit of a decline and staying flat, where you'd seen a bit of a mixed reaction from the markets. But recently, if data has been stronger than expected, then you get this sort of market reaction here. So that was so last time around wasn't as big as April, but still a decent market reaction. Now the currency space is what's usually seen the biggest market reaction in the currency space is the dollar yen. Okay, so also if you've noticed, if you've already subscribed to the MACROACE mailing list and you've got access to the ranges and deviations sheet, you've seen I've just updated the look, so it's much easier to kind of have a look at the have a look at the data. Do you guys like it? If you're subscribed to the MACROACE main list, do you guys like the new look? Hopefully, you guys should like the new look. It does make it easier. Anyway, so the biggest market reaction from the currency space came from dollar yen, and you see it had 72 pip move towards the downside, but after 10 minutes of trading, it was still down, but by 5.7, 5.5 pips. And then after about 30 minutes of trading, it went back down again by about 25.5 pips or 26 pips. So the currency space on the dollar yen was a bit more choppy, and in some of the other areas too. So that's something to be aware of, is that the market reaction was much stronger in the stock indexes compared to the currency space. So that's just what had happened last time around, when the data was in line, more or less in line with expectation. When you had data that was all going in one direction and there was a deviation, then you had a more consistent market reaction in the currency space, across everywhere, rather than when the data was in line with expectation, with one little outlier sticking out. Okay. All right, so I will go through how you can get access to the ranges and deviations sheet in a little bit, but we've got about 3 minutes to go. I'm just going to get the rest of the setup sorted, and just get our TICKSTRIKE up and running on here. But actually, I should let me get the setup ready first for myself, and then we'll make sure everything's all tickety boo. Okay, so there for the US. All right, so we're keeping an eye on the dollar yen. We've got the S&P here. We've got gold and the 2-year bond futures, or ZT. All right, so we've got about 2 minutes. I'll quickly guys give you the access, or the link then, to subscribe to the MACROACE mailing list. I'll give you a bit of a, there we go. To get access to the ranges and deviations, just subscribe to that mailing list. You'll get the access to range deviations. You get an email on Monday, and then you'll say click here for the deviations, and then you get access to that, and it's completely free. Okay, no need to pay for anything. It's completely free. Just pop in your email, sign up, and you'll get an email on the Monday. And it's one email a week that we put it out. So we've got about less than a minute. I'm going to go quiet, and hopefully we get data going in one direction rather than it being mixed, whether it be higher or lower. All right. So good luck, everyone, with the release. Don't forget, give us a like, share, and subscribe to the video. Get the word out there. And also good luck with your trading too. Hot dog. There we go. That was nice. So, see what I mean? When you get a deviation data going all in one direction, you get a big old finger then to inflation. Short-term interest rate futures jump after inflation data. Traders price in a bigger chance of a Fed rate cut. So TICKSTRIKE showing continued buying there. Okay, cool. Alrighty. Something good old day today. Okay. How did everyone else do on that? Was everyone else all okay? Hopefully you guys were. So that means then, so interest rates now, US interest rate futures now imply about a 70% chance of a Fed rate cut by September. All right, so that's probably keeping, that might mean, let's see. I think that's probably keeping 3 on the books then, in that case, for the potential for an interest rate cut by the Federal Reserve. TICKSTRIKE still popping. Okay. Okay, let's see what else we have. So if there's anything else that's coming through. I don't think there is anything else coming through at the moment. Okay, right. So, don't forget, did you guys find the information useful? Was it useful for you guys to understand? Hopefully it was useful for you guys to understand. Luckily, it did go one direction. Let's have a quick measure on the S&P then. Let's see. Let's go. Ooh. Okay. Let's see. 127 there. Gosh, this thing just went kapowie. I don't know what happened on the trading view. Sorry, not the trading view chart. The chart that I had here on Ninja, on Ninja Trader. I think it might have just experienced a flash error. So I did kind of look across and I'm thinking, why is there a big old red candle on the S&P? Am I going blind? Maybe I was. Okay, so momentum still kind of there for the, well. Okay, we'll see how long this lasts. So 127 to the upside on the NQ. It's about there's about 716 tick move towards the upside. Not the biggest market reaction. Still not as big as what we had seen when the markets were fearing a stronger than expected print. So that was on April 10th. Let's go and bring it across here. Where is it? Where are you? Yeah, so the biggest market reaction when the data was stronger than expected and the markets were super sensitive to it, as well, I mean, of course they always are, until the Fed starts to normalize and that they've got to their neutral rate and they're done. But that had seen about 954 ticks towards the downside off the back of that data. This one, data came in weaker than expected. Great, nice market reaction. Not as strong as April 10th, though. If the data did come in higher than expected, then you would have seen potentially a move towards the downside there for the NQ, and maybe even even as big as the April 10th data. But that's all to be seen so far. So, okay. Let's see. All right. Equities are doing well. Okay. There's a little bit of pullback here. All right. Let's see if there's anything else that's been said or anything else has happened. It's kind of hard to see. All right. So whilst we're having a little look around, then and having a so with Financial Juice, which is a live voice and text service, keeping you up to date with what's going on within the markets and the sentiment. Then, as you can see here, of what the traders and markets are anticipating then for the Federal Reserve. Not only that, but as I said, keeping up to date with all the news that's going on within the world, what's affecting the markets there and then, live and in real time via voice and text. So that is what Financial Juice is all about. As I said, keeping up to date with what's going on with what's going on in the markets, live and in real time, to give you guys keep you guys up to date, and then help you to then and then that will then, if you know what's going on in the markets and you know why the markets are moving in a certain direction, then that's the power that comes from having a live voice and text service that's in real time. So hopefully you guys, as I said, if you have seen Financial Juice before, if you are a user of Financial Juice, it sounds bad when you say it like that. I don't know where I'm going with that. But yeah, if you are a user of Financial Juice, then you will understand the power then that comes with having a live voice and text service in the background to keep you up to date with what's going on. Also, as says, you have your live voice feature here. So you have the live voice feature here, which you can see me kind of moving around with the little scroll bar. On the left-hand side, you have the economic calendar here of the upcoming economic releases and what to expect for the day ahead and also the week ahead as well. Of course, we have the FOMC later on at 2 p.m. Eastern Time, and alongside the rate statement and summary of economic projections. So, my personal opinion then, okay, not just a personal one, if this data has been weaker than expected, I'm probably seeing two rate cuts from the Federal Reserve overall this year, and one in, again, this is personal, so I'm just kind of rejigging my head here. Oh, there you go. I was going to say September. Interest rate futures now imply about 70% chance of a Fed rate cut by September. So one in September, and I think one in December. So I think they'll likely skip and then go to December for when they cut rates again. But that, of course, depends on data on how that then plays out in the future. So, all right. So if you want to keep up to date with the live, if you want to keep up to date of what's going on in the markets live and in real time, then you can sign up to Financial Juice. Okay, Financial Juice Pro, which is the link here. And you know what's even better? Even better is that we have a promo code. So if you want to get Financial Juice for 1 year, a year's subscription of Financial Juice, instead of paying about $1,100, then all you're gonna do is enter the code JUICY92. You heard me correct, JUICY92, and then you get 92% discount off of Financial Juice Pro for a year subscription, and you just pay $99 instead. Okay, so instead of $1,100, you're paying $99 for Financial Juice Pro for 1 year. Okay, so, but if you're joining up to Financial Juice for the first time, then make sure you create an account on Financial Juice here on the website, on the feed there first, so in the next link that I've popped here. Make an account for yourself on that there. Then select, then you'll see like a button here in the top left around here where you can see there where it says GoPro. Then click GoPro, select your subscription, put in the JUICY92 promo code, and then once you've paid for of course, yes, first set up your account, verify your account from your email that comes through. Once you've verified your account, then go and then pay for the subscription. Once you've paid for the subscription, log out and then log back into Financial Juice, and then you should get the beautiful version that I have here of the live and real-time version. Now, the light version of Financial Juice, when you initially go to when you initially sign up, if you haven't signed up already, it is delayed. There are adverts that do play, so you don't really get the full benefits of having the pro version of Financial Juice and having a live voice and text service to then keep you up to date in real time. But if it's the first time you've ever come across Financial Juice or live or a voice and text service, keep you up to date with what's going on, have a little play, get used to it if you're not ready to sign up for pro. There's no pressure, no rush. Only when you feel ready and that you like the product, then only then go ahead with paying for Financial Juice Pro. Okay. All right. So other than that, as I was saying, let's kind of, so yeah, that's Financial Juice there. Somebody said, Fearless Assassin said, worth it, amazing deal. Thank you for the videos. That was Risto. Kinshi says, NJ, thanks man, I learned how to be patient from these outages. Happy trading to you. Happy trading to you too. Gav Jam says, very helpful, thank you as always. I'll be back this evening. Yes, actually that's a good reminder. I'm going to harass you guys a little bit more. I'm going to chuck in. Also, don't forget to subscribe to the channel, get the word out there, and also share the videos as well, and the live streams. Let me just bring it up here and copy that link. I'll pop it in here. Okay, so if you want to join me live at 1:15 p.m. Eastern Time for the prep, then for the FMC, there you go. Jump on that there, and you can have, and then we can go through the FMC prep. All right, so that's Financial Juice. That's the link there for the FMC later on. Seeing a little bit of a reversal on the S&P, a little bit of more reversal on the NQ. So let's see what we've got here. So it's just kind of keep the pressure there. All right. Okay, so let's carry on then. Now, TICKSTRIKE, if you're unfamiliar with what TICKSTRIKE is, TICKSTRIKE, what it does is it allows you to keep up to date with what's going on with the strength and in the buying and selling momentum within the markets. Okay, and that's in different asset classes. That could be in currencies, FX, stocks, futures, covering all those areas there. It could also be in ETFs and ETNs, and your internals like your VIX or ADD. I think I've already said crypto, but I'll say it again, crypto space as well. And it represents the buying and selling momentum of that asset. So if I just bring up one here for you now, if we're looking at the S&P. So here where we can see, so this is the ticker box, which will give you a visual and audio alert to the strength of buying and selling momentum within that asset. And there are different levels. So this of different levels of sensitivity. So one is very sensitive to market reactions. So when there's a bit of buying or selling that occurs, TICKSTRIKE will then give you a visual and audio alert. And then if you want to see, okay, dollar taking a further plunge here. Equity indexes I was trying to do a bit of a pull continuation. But as I say, yeah, so level 1 is very sensitive. Now, as you increase that number all the way to 15, and you can chop and change it on the way up there, 15 is the least sensitive to market reactions. So only when there's a big amount of buying and selling momentum that occurs will TICKSTRIKE then give you a visual and audio alert. So you can see here, this is on level 15. the lowest sensitivity. So everything else here, seeing a bit more of a market reaction, seeing a notification popping off here, but on this you don't get anything until it hits that until you get that nice old 15 in that number. Now remember, this is showing you the strength of the buying and selling momentum of that asset. So if you're, particularly if you're day trading, if you're looking to capitalize on potential opportunities or confirm which way you're trading or manage your risk, then TICKSTRIKE is then that tool for you to then use and capitalize on within the markets. Okay, so it's very useful then to be able to capture that there. All right, so TICKSTRIKE. Now, actually, I did want to show one thing, which I forgot to show you guys. Now, if you like to scalp the markets, okay, if you're a hardcore scalper and you want to see every bit of buying or selling momentum that is occurring, okay, this lightning bolt will then show you that there. Okay, so I'm going to move my mouse away, and you'll see that it's way more sensitive. It's uber sensitive to the market reactions, and bing. Okay, so every little bit of buying and selling that is going on, as you can see here, that there is that selling momentum that is occurring within the S&P. Okay, every little bit of buying and selling that's going on, TICKSTRIKE will then give you that visual and audio alert. Okay, it's a bit crazy for me, but if you like to scalp the markets, then that is there for you, of course. So just to make it a bit clearer, so this is the lightning bolt is 15 levels below 1. So if 1 is very sensitive, 15 levels below that then is uber sensitive to market reactions. Ead says, can you do a live demo of TICKSTRIKE? That whole video was done on a long time ago when it was first launched. Well, you can kind of see it now. Yeah, you should be able to see it. Are you not able to see it? I mean, you should have been able to see it throughout the whole. I mean, when I started doing, when it came to the economic release, you guys should have seen it. Okay, so yeah, if we're keeping an eye, so an ideal way for myself when using TICKSTRIKE, usually after the economic release occurs, if the momentum where is moving towards the upside, and if I've got a trade going, then if I start to see that the selling momentum starts, so let's say I'm going long on the S&P, and then what I usually do for myself, I kind of keep it at around 8, 9 or 10 usually. So if I keep it at 9, if there is a strong amount of buying or selling momentum that has occurred, then if there's a strong amount of selling momentum that has occurred, then there must be some bit of news that might have appeared. That's the first thought that I've had. If there is a strong movement towards the upside for some reason, towards the downside, that's caused the markets to move in the opposite direction, then of course to then manage the risk and then have a look at the chart and then take my decision, and then just monitor it, and then of course have my stop loss ready just in case. Okay, so again, I use it for managing risk more so than taking the opportunity to take a trade personally myself. But unless it is an FOMC rate decision where the statement is very hawkish or dovish, and that is providing a decent market reaction towards whether the upside or downside, then I could then use it to see how strong is that buying or selling momentum and how long can I stay within the market, within the asset. So if you see a continuous amount of selling and you're looking to go short, and then you see some buying momentum that comes in, again, this is not how you have to use it, but then it could be the trigger to then go, okay, maybe I should then pull out, and the selling momentum is kind of dying off, and so I could risk it and go further, or I could just pull out and then say that's it, I'm done, and vice versa. the other way. Okay, so yeah, that is TickStrike there for you. Now we have here is a link here. Remember, with TickStrike, it's different for everyone. Setups are going to be different. The way you use TickStrike is going to be different, and how you use it. You need to have a play with it yourself, to be honest, to then kind of figure out what style works for you. There isn't just one style that's going to work. I mean, my style works for me. Your style is going to work for you. Same with trading and your strategies. So, do what works for you. And then yeah, you're on your way. Yeah, and with TickStrike you can see this was a good point too with correlations. So if you're seeing a correlation with all the equity indexes seeing a move towards the downside, then of course then there is a continuation of that decline, or there's a stronger chance of a continuation of the decline for the equity indexes, or something has affected everything there. But if you see a bit of a mixed bag where some of the equity indexes, well, let's say the Dow is up or seeing strength, but the NQ is seeing a downside momentum, and the S&P is as well, then that could mean that there's something kind of going on specifically with those two equity indexes, or that equity index for the Dow. Same with currencies as well. You can use it for correlation. So that's also a good point too. Which way is the dollar moving? Is the dollar seeing overall strength within the market, or is it seeing overall weakness? As we can, at the moment, seeing a little bit of strength. If we're looking at the euro dollar going down, cable going down, and dollar yen going up, that's on level 1 for level 1 sensitivity. So, and here you can also look at the Dixie too. So you see the overall strength again just from the Dixie itself. So if you do see a bit of that selling momentum that's occurring on the dollar, yeah. So that's another way that you can use it. But as I said, have a little play first. Figure out which way kind of makes sense for yourself, and only then will you then you understand what works for you. But you can have a play of the free version on the Financials feed. Here you've got the S&P, Euro Dollar, Oil, and Bitcoin. The level of the sensitivity is restricted to, I think, 6. Well, that might have been updated, but last time I checked, it was about 6. But yeah, so you have that mark. So yeah, have a little play with the free version. That's on the light and pro version of Financials, by the way. You don't have to get pro to get access to the free version of TickStrike. But a little taster for you to have a little look at, and then kind of get used to it. And then when you're ready to go pro, then you have the link there as well. Reverend says, is it possible for the euro to be on the downside for this month due to elections? Well, we already had the downside reaction from the elections from Sunday night, but then we had moved back towards, we'd kind of moved back towards the upside off of the back of the initial scare, or the initial shock then that the markets had seen. Macron calling for an election for June 30th, and then the second round in July. I think it's July 6th or 2nd, but a second round vote is also being called too. So if Macron loses and he gets trumped in the election, then you could see some further downside from the euro, because there's instability that then comes along with the more far right leaning parties that are centered to the right, more far right leaning parties. Then that could cause the instability within the euro area, and in turn from that instability could then provide some downside movement to the euro as like a first starting block. And then if you see like a domino effect of other nations within the eurozone seeing a move towards the far right in their own general elections that they hold, then that could provide some further downside for the euro if that were to occur. All right. And yeah, Germany would be quite interesting to see if the AfD completely, well, if they do completely take control, if they start gaining even more control of Germany, and then that could provide a bit of trouble then for the euro, not just for the euro, of course, but potentially for the eurozone area and maybe for Europe too. But hey, whatever you believe in, cool. That's your view. You know, if you're very right wing or if you're very left wing. So, you know, that's completely down to you. Okay, I've spoken a lot. I've got to catch up on the market reactions. FMC, remember the live link post is, I mean, you can still see it. It's there. The link is there in the chat. Okay. Let me copy it in again, just so you see it at the bottom. Okay, there it is. Hopefully you should see it there too. All right, don't forget to like the video, share, subscribe to the channel, get the word out there, and I will see you guys, well, later, 1:15 p.m. Eastern Time. All right.